Welcome to Mortgage Markets and More. I'm your host, Peter D'Angelo. Welcome to Friday and welcome to November, everyone. Flipping the calendar now. Got a big update for you. Quite a bit's been going on, so we're just going to dive right into it because there's a lot to share today. So we're going to start off with mortgage rates like we normally do. These rates are the averages as reported by Mortgage News Daily, and here's where we're at. 30-year fixed rate mortgage is averaging 7.02%. That's up from 6.92% last week. The 15-year fixed rate is at 6.5%, up from 6.38% last week. The 30-year jumbo is averaging 7.15%, also up from 7% last week. The 30-year FHA is at 6.54% on average, up from 6.38% last week. And the 7.6 SOFR adjustable rate mortgage is averaging 6.9%, up from last week's 6.78%. So overall, pretty reasonably flat. Slight increases on these averages, but status quo for the most part. Let's get into what the bond market's looking like, which is paving the way for where these rates are. As of recording this podcast on the Thursday before, a little later into the day, it's moving. So these are last time I checked, which was just about a couple hours ago. So when you're listening to this on Friday, this bond market very likely will have changed, and we're going to get into that shortly. But as it stands, the 10-year U.S. Treasury yield is at 4.286%, up from 4.192% last week. The 5-year Treasury yield is at 4.163%, up from last week at 4.005. The 2-year Treasury yield is at 4.183%, also up from 4.049% last week. Yields have gone up a bit, and some of the reason we talked about last week, there's an increased supply of bonds available, and there was the auction that we discussed last week. Increased supply with the same amount of buyers or lower demand even, that could possibly be the case, creates the yields that go up. Big part of the reason why we talked about before, but it bears repeating, especially today being just days away from the big day, the election. The election has a lot of people holding steady. Here's also some things to consider as to why interest rates have gone on this move that they have as of recently, and also a little bit of insight as to where they could be going. So first and foremost, we got to talk about the economic data. You're probably tired of hearing me say it at this point too, but the economic data is driving a lot of the investing decisions, a lot of the market movement, and as long as we are waiting with bated breath to hear what the Fed's next announcement will be, we're going to be looking, and people who are investing in the market are going to be looking at the economic indicators, which the Fed will be looking at to try to anticipate where their policy is going to be set forth and also what the interest rate environment will look like moving forward. First up, the initial jobless claims, the October 19th report, came in at 227,000 for the jobless claims. The expectation there was 245,000, and the prior reading from the prior month, or the prior report rather, was 242,000, which we talked about last week. So a little bit more going, in that direction, which means a little bit maybe of weakness. We could put an asterisk next to that because there's also to consider the fact that with this jobless claim number, it may be capturing some data from the hurricane-ravaged areas of the country for people who have filed that they don't have a job. Also, we got new home sales, and that came in at 738,000 versus the forecast of 720,000, and the prior reading was 709,000. So those newly constructed homes. So a little bit stronger, a little more activity happening there. The other thing that maybe could have moved the market was consumer sentiment. This is essentially a reading to see what consumers think of the economy and what their outlook is for the market. And that came in at 70.5 rather, and that's up from 70.1, a little bit better than expected. Also, job openings. So this was the JOLTS report, the Job Openings Labor Turnover Survey, which was released earlier this week. That came in at 7.44 million. That is below what the estimate an expectation was. The expectation was for that number to be 8 million. So it came in cooler, a little bit of cooling in the job market. That for us, and when we're talking about interest rates, is, quote, good news, because any weakness in the job market could create case for the Fed to continue their interest rate reduction campaign and lowering what the Fed fund rate is, and then that translates over to lower interest rates. That being said, here's where the mixed bag comes in. The ADP employment survey came in at 233 jobs added, which blew past expectations, which the forecasting was 113,000 jobs. So double. So that's quite a bit strong. Now we've got a mixed bag we're dealing with here. The prior reading was 159,000 from the prior month. So there is some strength happening there too. With respect to the ADP employment, if there were any strikes or anything like that, which should be considered, one that is currently ongoing and that could be relevant with the data we're looking at is the Boeing strike. The workers at Boeing had worked out a deal, and now that deal has not worked out. So that's the type of thing that can influence jobless and employment added when we're looking at the ADP employment data. GDP, gross domestic product, this is our indication of how well the U.S. is doing by what we're producing and gives you a really good look at the economic environment for the country. GDP reading came in at 2.8%. That was below the expectation of 3.1% growth on an annualized basis. That's what these numbers are indicating. And the prior reading was 3%. So a little bit of contraction on the GDP, but there seems to still be a sentiment that it's just a moment in time, and we still have a lot of retail ahead of us with the holiday shopping season getting into swing, and likely this holiday season shopping is going to be spread out because Thanksgiving happens at such a late point on the calendar this year. It's the very last week of November, creates a crunch for holiday shopping ahead of Christmas. So after Thanksgiving and Christmas, Hanukkah, all of the holidays, that's going to probably create a more spread out retail sales environment. Also, pending home sales shot through the roof. So they came in at 7.4% growth, and that is far above what the expectation of 0.7% growth was. And the prior reading was 0.6%. Think also we had lower rates when the expectation was for the Fed to cut the rate. That created the rate environment that saw interest rates sometimes getting as low as 6%. Sometimes you were even accessible in the 5% range, in the high 5% range. With those low rates, more people probably had more activity in the market and more people were purchasing homes. So this reading is showing us that those rates definitely created an environment where there's more affordability. And more affordability means more sales, more homes under contract. So the pending home sales currently blew through expectations. I think this is the highest growth amount since 2022 at this point, which is incredible. There's, as you can see, mixed economic data. It's not painting a picture for us of any kind of confidence, let's say, where the Fed's heads are at when it comes to creating their monetary policy, which brings me to what to look at ahead. And also, I delayed recording this episode so that I could report out to you on a couple key pieces of data which just came out, which is the personal consumption expenditure, PCE. For those smart kids at home, you'll remember. I will refresh your memory if you had forgotten. The PCE is one of two major inflation indicators, the consumer price index, which we reported out on a couple weeks ago, and then the PCE, personal consumption expenditure, is another inflation reading, and the PCE is the preferred inflation gauge for the Fed. So they're looking at this very intently, and here's where the numbers are. Overall, PCE month over month showed price growth of 0.1%. It was a little bit lower than the expectation of 0.2%, and last month was 0.1%. Core PCE, month over month. Now, to refresh your memory also, what I just mentioned is what we call the headline number for PCE. So PCE, that encompasses all things that you pay for. The core takes out the volatile elements, food and energy. So anything related to food, anything related to energy gets removed from the data, and then we get a look at what that core personal consumption expenditure looks like. Month over month, that core previously, last month, was 0.2%. The expectation this month was 0.3%, and we landed at expectation, 0.3% growth. So pretty much in line across the board. The expectations and the actual, that's good. So we've got a good sense of where things are going. Now let's look at the year over year, because this is the important part of the data. So the PCE year over year previously, last month, was reading at 2.7% price growth inflation. The expectation this month was 2.1%, and it came in at 2.1%. Reminder here, the goal is to have inflation reach 2%. We're within 0.1% of that. This is the strongest case we've had so far if the Fed is going to continue to be proactive in cutting interest rates to avoid a recession and to avoid too much of a shock to the economy. So this is a good piece of data. The core PCE, this is where we start to see the difference between the headline and the core. The core PCE year over year previously was 2.7%. The expectation this month was for it to be 2.6%, and it came in actually at 2.7%. So just a touch hotter. That could be rounding. So quite frankly, I think we can call that meeting expectations. So when we take out the volatile elements, it's a little bit hotter, but the headline is the important one to pay attention to. The Fed's still going to pay attention to the core, and they're going to take it all under consideration. But the really important one here is that headline. So past episode, I think it was 2 weeks ago, I was like, this is the report that I'm intently focused on. This is going to tell us quite a bit about where the Fed could be at when it comes to their next meeting, which is next week. So let's talk about this. We still have some more key pieces of data that we're going to be getting. First and foremost is the U.S. employment report, the unemployment and hourly wage growth. If unemployment stays at 4.1%, here's a fun fact. If it stays at 4.1%, which is going to be released tomorrow, that's when we're going to get this information, it will be the lowest unemployment rate ahead of a general election in 24 years. So for those concerned about the economy is doing pretty damn good, especially when we're taking into consideration this comparative analysis every 4 years, going back 24 years. That's pretty good. If it's good, it means there's less of a case for the Fed to cut their interest rate. Other market movers. The election results. What happens next week is going to move the market in one direction or another. You can talk to wealth advisors. I don't want to speak out of turn or go beyond my core area of expertise. But when we consider what has happened in the past, who wins the election does not really have much of a tangible effect on the market. But what it does have is the tangible effect on people's psychology and what they think. And then they will act accordingly, and it will have an impact. So that's an important piece to keep in mind. The election, the way that the calendar worked out is wild this year. The election's happening on Tuesday. The Fed normally meets in their Federal Open Market Committee Tuesday, Wednesday on the months that they meet, and then they make their announcement on Wednesday. Given the election, they are meeting Wednesday, Thursday next week. So the 6th and the 7th of November, and their announcement's going to be on the 7th, and their Fed Chair Jerome Powell is going to announce out what their monetary policy is going to be, as well as commentary and field questions. I will report on that next week's episode. So I'm going to make sure I do the episode late enough so that I can report out on that on Friday, so that you've got that information readily available. Taking into consideration all of this, I wanted to explore maybe a little bit of a controversial idea that I had. And it's something to tease out. And this is where I also welcome feedback. So, every episode I say, reach out to me on socials, email me. My email address is in the episode description. Feel free to reach out. And I would love to hear your feedback on this. But here's where I'm at. This is what I'm thinking. We've been keeping an eye on rates for a while and taking a look at the interest rates and where they are and where they could be going. We've seen a lot of volatility. We've seen them go low. We've seen them go high. And it keeps this little bouncing kind of trend. Now, overall trends down, but now we find ourselves within like a very particular margin, particularly if we just look at the past 52 weeks, where interest rates are, on average, are almost squarely dead center of the middle of where interest rates have been for the past year. So knowing this, and now it seems to be establishing kind of a solid foundation as to where interest rates are, I'm going to make this controversial claim. Perhaps a higher interest rate environment for a longer period of time. So for purposes of my argument, let's just say the 6.5% to 7% range, right? We saw that having rates 6% and lower, possibly even, created an explosion in pending home sales by a growth rate of 7% and change. That's great. When you have that much, though, there's a lot of competition. Competition yields higher values in property. That means we have more property appreciation. So my argument here is if we keep interest rates and we see interest rates stay higher for longer, maybe there's a silver lining in that rate environment could possibly help to start stabilizing the home value component. We know that inventory is a struggle in certain markets. In other markets, not so much. I'm going to talk now exclusively about the New York metro area market. That's where I operate the most. I could speak to that the best. Inventory is tough, especially here in New Jersey. With low inventory, obviously, supply and demand. Low supply, high demand, high price. If the interest rate environment stays consistently higher, maybe a silver lining there could be that then homes that are sold and homes that are listed for sale may not continue to see this crazy, compounding, exponential at this point growth on home values. Home value appreciation has gone wild. I talked to someone this week. They purchased their home in 2018 for $500,000. They're looking at $1.1 million now as their value, conservatively. Doubling in that time period. If we have higher rates, maybe that could start to stabilize home prices. Another reason why this could be a good thing. Higher rates for longer, unfortunately, does continue to present the affordability obstacle. But if the home values can start stabilizing and we don't continue to see, last reading when we talked last week, it's like in New Jersey, in the New York metro area, it's 5 to 7% property appreciation depending on your market. That's crazy high. If that starts to compress a little bit, I'm not in the camp that believes that home values are inflated and they're going to just drop like a stone. There's too many elements that need to happen, and I don't see them materializing for that to be a realistic case. However, I do see where we have higher interest rates for longer, home value appreciation will not be running at the same rate. Maybe it's only 2 to 3% appreciation. Even that could start laying the foundation for a healthier market, so that if and when interest rates start to come down and we start seeing things maybe closer to 6% and more buyers now have the accessibility of the financing and it's more affordable, home values will go up again because of the demand that will enter the market. But at least leading up to that point, we didn't have 5 to 8% appreciation. Rates drop like a stone. Now we've got another 10% appreciation on homes. And I'm pulling these numbers out of thin air, but they're realistic. They could be. So I'm making a case right now. Higher rates for longer for mortgage interest rates may not be the worst thing in the world. I know it's a tough pill to swallow, particularly if you're waiting for low rates for you to sell your home. That's the only part here that's the hiccup. But if we take the assumption that the market continues to operate the way that it has, let's just say for the past 52 weeks, we're already seeing an increase in inventory, homes that are listed for sale nationwide. In some markets like the New York metro area, it's tighter, but it's trending in the right direction. So if that trend continues, even with interest rates being volatile within this margin that is, let's say, 6.5 to 7%, we could see property appreciation growth rate get tamped down just a touch. And then that could make way for if and when rates go lower and you've got more buyers coming off the sidelines, now you're good. And then for you on the fence, if you're thinking about selling, it could make more sense at that time. Now for the did you know section, I'm going to give you some secret sauce here. Full disclosure, I'm giving you the secret sauce. Came up with a couple clients and families I was helping out this week. So I thought, Bingo. This is the thing to talk about. We're going to talk about appraisal gap guarantee coverage. This is something, shameless plug, that we specialize in at Rate and that we can help with, and it is extremely effective and helpful, particularly in this very competitive market. So let's just recap some of the highlights of what's going to be important to know about so that we can talk about this topic. Appraisals. When you purchase a home, you're going to be negotiating a contract prices written up. On our end, an appraisal may be necessary. Sometimes you don't need an appraisal. I'll save that for another time. But let's say you need an appraisal. We work with an appraisal management company. We order the appraisal. An appraiser goes out to the property, inspects the property, takes photos, does a comparable sales analysis, pulls in the comparable sales, which are homes that have sold recently and are of comparable size, structure, and quality. And that's how they derive the value of that property. Now, when you're negotiating your contract, to go back to that point of the process, it has been something that's been very helpful and effective for prospective buyers to include in their offer, letting the listing agent know, I am going to waive what's called the appraisal contingency. In the contract, typically, there is a clause that says if the home value, as per the appraisal, comes in lower than what the purchase price is, we will renegotiate this contract. So let's say you're purchasing a home for $500,000 and you have that appraisal contingency. If the home appraises for $580,000, now you go back to the seller, go work with your attorney or your real estate agent, and you go through the process of renegotiating that. All right, we'll meet in the middle. We'll do $590,000, whatever it could be. What I'm offering is a way to navigate this so that you don't need to worry about that negotiation. It's proven to be very effective to include that appraisal waiver, which means you're telling the seller, regardless of what the appraisal comes in at, we're not going to renegotiate this contract. That could have implications. On the lending side, we will go based off of the lower of the appraised value and the purchase price. If the appraisal comes in under and we've structured your loan with a particular type of financing, let's say you have 10% down, well, to maintain it, your 10% down is going to be now based on the lower value of the appraisal in this shortfall scenario, and then you'll have to come up with the money for the difference. So a lot of buyers are a little bit scared of putting an appraisal waiver in there. God forbid the appraisal comes in shorter. Here's a solution. It's called an appraisal gap guarantee coverage. What this allows you, and it works best if you have 10% down or more, but how this operates, you go under contract, you put the appraisal waiver in. Let's say you have the appraisal done. And for purposes of this argument, we're going to say you are putting 15% down to purchase the home. Well, the appraisal comes in short. You waive the appraisal contingency. You cannot renegotiate this contract, and you don't want to spend any more money out of pocket. Well, the solution that we have is we can use the same allotted amount of funds that you were going to use to purchase that property at the purchase price. And minimum down payment for conventional financing, I'll just speak to that right now, 5%. First-time home buyers, 3%. So if you're planning to put 15% down, you've got the difference between 3% and 15% as latitude. So if the home value comes in, you're still meeting what the minimum is. And what we do is reallocate those funds that you were already budgeting to come out of pocket with for down payment and closing costs. And we reallocate them so that it's covering that shortfall. And then we can leverage a mortgage insurance product that will pick up the rest so that effectively you can proceed with your transaction with no negative impact to your out-of-pocket expenses. You can keep your out-of-pocket budget, and the monthly payment can stay the same or be extremely comparable, and there's different ways to navigate that. But that is how we do it. That's the Appraisal Gap Coverage Guarantee. That's also it for the show today. If you have any questions or anything you'd like to hear covered on the show in future episodes, please reach out. Reach out to me on socials, my cell, email me. Again, my email address is peter.d'angelo@rate.com. I look forward to next week's update. If you have anything that you would like me to cover, I will be talking a lot next week about the Fed decision, obviously, because that's going to be Thursday. I'm going to make sure I produce the episode right after that so we could report out. But please reach out if there's anything that you'd like to hear about. Otherwise, have a fantastic weekend ahead and take good care.